Your 401k is bleeding. Gold just crossed $5,000 an ounce. And somewhere in New Jersey, a 68-year-old retiree is staring at her screen, hoping she has enough time to recover. Hope. That's not a strategy. Welcome to the IRS 7702 news. The private wealth briefing built for people who decided to stop hoping and start building. I'm your host, Lamar T, and this is episode 2. Today, trade wars rattling your retirement. IUL break record. But there's a catch. The FIA market crosses $500 billion. And the 3 tax-free moves that make the wealthy completely immune to market headlines. Let's get into it. The storm outside your window. Now, welcome back to the IRS 7702 news, the show where we peel back the curtain on financial strategies the wealthy use quietly, consistently, and legally. I'm your host, Lamar T, and you are exactly where you need to be right now. Because right now, the world is on fire. And that's exactly when tools like the IRS Section 7702 earn their keep. Let's set the scene. It's Q2 2026. Trade wars are rattling Wall Street. Dow Jones hit its lowest level of the year in early Q1. Tariffs on goods from dozens of countries have sent shockwaves through the supply chains. Grocery bills are up. Healthcare premiums for ACA marketplace participants have, in many cases, doubled. And retirement savers across America are logging into their 401k accounts with one eye closed, bracing for the number they'll see. Here's a line that should haunt every 401k investor right now. I'm just kind of stunned. With so much money in the market, we just sort of have to hope we have enough time to recover. Now, that's what a 68-year-old retiree in New Jersey, speaking at NBC, said on news this year. Hope. Is that your retirement strategy? No, it doesn't have to be. And that's why you're here. Now, the micro picture and what's really happening out there. Okay, let's talk geopolitics and global markets because they matter to your financial architecture. The tariff game. Well, the tariff regime currently in place has created what economists at the IMF describe plainly as a policy shock, something that depresses trade, investments, and output persistently. The Federal Reserve Bank of New York found that roughly 3/4 of firms hit with tariff trade-related costs are passing these costs straight to consumers. You're paying, your clients are paying, and their retirement accounts, if parked in traditional market-exposed vehicles, are feeling it too. In January 2026, gold surged past $5,000 an ounce. Silver crossed 800. Safe haven assets are screaming something, and smart money is listening. Meanwhile, the S&P 500 is navigating whipsaw conditions. The NASDAQ has brutal stretches, and the people are most damaged. The retirees and near retirees who were told that a 60-40 portfolio was sufficient armor. LIMRA, the gold standard for insurance and annuity research, has already adjusted its 2026 forecast. They expect economic conditions to weaken this year. Quote, over life insurance, new annuitized premium growth is expected to land between 2 and 6% in 2026. Well, below the double-digit surge of 2025. The party in traditional markets is being gate crashed, and the smart money, it's moving. The IUL markets, records, realities, and what to watch. Now, let's talk about Indexed Universal Life, the IUL, because this product just made history. According to LIMRA's final 2025 numbers just released weeks ago, IUL's new annuitized premium hit $1.3 billion in quarter four alone, up 12% a year over year. Policy count jumped 13% that same quarter. For the full year 2025, IUL captured 25% of the entire U.S. life insurance market. That's 1 in 4 premium dollars flowing into the structure. Lima Research head Karen Terry put it clearly, IUL sales continue to be a bulwark for for the individual life insurance sales market. Expanded distribution, enhanced products, and a strong equity market all contribute. And despite economic headwinds, they're projecting a double-digit IUL growth again in 2026. Now, here's where we get real. Because this doesn't do hype without homework. IUL is powerful when it's designed right. But the industry has a marketing problem that we need to call out directly. Too many agents are showing illustrations that assume consistent 7, 8, or even 10% returns every single year. That's not how it works. Some years you earn the cap. Some years you earn zero. Zero, not negative. The floor protects you, but zero. And if you run zero for 2 or 3 years early in your policy, the impact on long-term performance is significant. What you need to watch for in 2026. Caps and participation rates are moving. Several carriers have been adjusting these downwards as they manage their option budgets. Some carriers are getting creative, offering higher caps, but charging additional fees. Read the fine print. Understand what you're actually buying. The cost of insurance rates rise with age. And IUL, the pure insurance cost escalates every year. If your cash value doesn't grow fast enough to outpace those rising costs, you can end up in a policy that is quietly draining itself into your 70s and 80s. This isn't theoretical, it happens. The good news, a properly structured IUL, overfunded minimum death benefit with a legitimate carrier who has a track record of stable caps remains one of the most powerful tax advantage accumulation tools available under the IRS Section 7702. Tax deferred growth, tax-free loans in retirement, no contribution limits tied to income, no required minimum distributions, and a death benefit your heirs can receive, income tax-free. That's just the package. Just make sure the packaging is honest. The FIA market, $500 billion in protected assets. Now let's pivot to the fixed index annuity market, the FIA. And this story is nothing short of extraordinary. In 2025, a total U.S. retail annuity sales hit $464.1 billion. That is a 4th consecutive year of record sales. 8 straight quarters above $115 billion. In the third quarter of 2025 alone, the market topped $120 billion in a single quarter. FIA specifically closed 2025 at $1,279 billion, up from $54.5 billion a decade ago. That's a 135% increase in 10 years. And here's why that number matters. These Americans are choosing principal protection. They're choosing zero floor guarantees. They are choosing not to go backwards. The demographic wave behind this is peak 65. Lemur's term for the current moment where 4.1 million Americans are turning 65 every year. Many have no pension. Many have watched their 401ks gyrate through tariff headlines. They are looking for something that lets them sleep at night. FIA has delivered that. Now, here's how the math works in that environment. Let's say you move a portion of your assets into the FIA. That credit's based on the S&P with a 0% floor and a cap at, let's say, 9 to 11 range. The market has a rough year, down 50%. Your FIA credit's zero, not negative 15, zero. Your gains from prior years locked in. The annual reset feature means that last year's growth becomes your new protected baseline. In Q1 of 2026, the FIA cap rates actually increased almost major term lengths, rising roughly 20 to 75 base points depending on the contract duration. Multiple carriers are competing for your business. Lemur projects annuity sales to remain above $450 billion in 2026, supporting what they call manufacturing contracts and money in motion, meaning trillions of dollars sitting in existing contracts that are rolling over and looking for a new home. Registered index-linked annuities, RILAs, are sometimes called buffered annuities. they're also exploding. They posted a 79.5 billion in sales in 2025. That's 10 times what they sold a decade ago. When they were projecting RILA to exceed 85 billion in 2026, these products accept some downside risk in exchange for higher upside potential. Think of them as FIAs with the training wheels just loosened a bit. The 7702 angle, why this moment matters. So let's bring it all together with the tax code. IRS Section 7702 is the provision that defines what life insurance contract is for federal tax purposes, and by doing so, it defines the entire framework of benefits you receive. Tax-free growth, tax-free loans, income tax-free death benefit, the Holy Trinity. In the current environment, with tariffs creating inflation pressure, with tax cuts from the TCJA still extending, but political uncertainty around future tax rates growing, with Social Security benefit structures undergoing scrutiny, the value of a 7702 compliance structure is not academic. It's urgent. Here's why. Every dollar you grow inside a property structured life insurance contract grows outside the IRS's reach at retirement. You don't get a 1099. You don't trigger a ARMR, surcharges on your Medicare premiums. You don't trigger provisional income thresholds that cause your Social Security to be taxed at 85 cents on a dollar. In a world where the government is actively looking for revenue and where trade wars and deficit spending are dominant fiscal themes in 2026, building a tax-free bucket is not a luxury. It is a defensive necessity. The 2020 update to 7702, which lowered the applicable interest rates to test policy compliance, opened the door for even more efficient overfunded. That means more premium into cash value, less into the death benefit. More growth engine, less pure insurance costs. If you haven't revisited your 7702 strategy since the legislative update, that's your homework this week. What to do right now? Your action items. We don't leave you with just a playbook. Here's what this episode demands from you. Number one, if you have a 401k or IRA that has been hammered by market volatility this year, have a conversation about repositioning a portion, not all, into principal protected vehicles. FIAs are purpose-built for this. Number two, if you're a high-income earner already maxing out your qualified plans, review whether a properly structured IUL makes sense as a supplemental vehicle. The absence of contribution limits and RMDs alone make the conversion worth having. Number three, ask your strategist specifically about cap rate stability, which carriers have held their caps consistently over 5 to 10 years, and which ones lure clients in with high gaps and then drop them 12 months later. History matters here. Number four, get clear on your tax exposure in retirement. A financial plan that doesn't account for tax bracket risk is an incomplete plan. How much of your projected retirement is income tax free versus tax deferred versus fully taxable? And number five, do not let geopolitical noise make you reactive. Tariff headlines change, trade wars escalate and de-escalate, but the structural advantages of 7702 doesn't change with a tweet. That's your episode with the IRS 7702 news. If this episode gave you one thing to think about, one conversation to store, one policy to review, it did its job. Share this with someone who needs it. Review your coverage, and remember, the wealthy don't hope for a good market. They build structures that don't require one. Until next time, protect the principal, grow the cash value, and leave a tax-free legacy. Until the next episode, this is episode 2. Finito, la ma petite. Peace.